welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, chief strategist of Interactive Brokers, to discuss one of my favorite topics, technicals versus fundamentals, one of the existential questions that have befuddled investors forever. And Steve, as you noted this week on the Interactive Broker Traders Insight, fundamentals usually drive valuations in the long term. Stock prices in the short term can diverge substantially from what fundamentals might seem to apply. And often at times, analysts wildly disagree on the fundamentals. Technicals, on the other hand, are in fact the prices that assets are trading at, but there are many out there that are dismissive of technical analysis. Why is that?
Well, wow, how long do we have, Jill? We could do this for an hour. Let me try to make it succinct. Technical analysis is sort of considered a little bit of financial voodoo by many, and I say this as someone whose first summer job was basically working for a technician. I did it for 2 summers, and I loved it. But the way I look at it is the fundamentals, are the stuff we learn in business school, cash flow, balance sheets, et cetera, et cetera. The technicals, the problem, I look at them as extraordinarily useful from someone with a trading mentality. And I remember I was a professional trader for over 25 years. And the technicals to me were my roadmap. The fundamentals might have told me where the destination was, but the technicals told me how I was going to get there. Where might I find support? Where might I find resistance? Remember, I was a market maker, so I was basically had to sell into strength and buy into weakness and that sort of thing. And you have to pick your levels very carefully about where you're gonna make your stand if you're forced to do that, and how do you price? And the technicals are very helpful. To a certain extent, they might be self-fulfilling. Moving averages are sort of what they are, but support resistance levels, chart, and charts themselves can be interpreted in different ways. They're a bit of a Rorschach test sometimes. But in general, I think if you're trading and investing, you have to understand both of them, but you do have to put them in the proper perspective.
Yeah, especially when you're looking at time and price and so forth. But you had mentioned before that the fundamentals, that's what's happening with the balance sheet. Is there cash on the balance sheet? Can they service their debt? What are they trading within multiples relative to peer? So when we take a situation like Silicon Valley Bank, I have to ask you about this, Steve, where regardless of what the chart said, when this news came out, and it started to just avalanche over the past few days, and now the bank is going under. How do you even use technicals with something like that? Or what does come first, fundamentals before technicals? Or I think that's kind of where the argument lies. Does one predict the other?
Over time, fundamentals win. You can't escape the fundamentals. If you're a company that doesn't make money, or a company that can't service their debts, or you're trading at a wild valuation that seems almost impossible to grow into, it's almost impossible for that to try, for that not to take effect. We can point out some exceptions that have occurred over time where certain companies have had outlandish valuations and actually grown into them. But the vast majority of cases, the fundamentals win. And in a bank, the fundamentals definitely have to win, because so much of it is based on perceptions of soundness and security. In the case of SIVB, someone asked me today, what do you think the book value is? And I said, I have no idea, because the numbers I'm dealing with were from the end of the year. All I know is they had to take a $1.8 billion haircut on the most liquid portion of their portfolio, but I don't have the transparency to figure out what the rest of the portfolio is worth. Now that said, I'm not a bank analyst, so I'm not in a position to go into the books in that detail. Somebody can, but ultimately that's what it came down to. And in the case of the bank. In the case of banks in general, which is why it spilled away from just SIVB, is the fact that you're in an inverted yield curve environment. Banks typically make money by borrowing short-term through demand deposits and other short-term measures and money markets, and lending long-term, corporate loans, mortgages, et cetera. Well, that's really a good business when you have a fairly steep, normal-shaped yield curve. It's not a good business model when you're inverted. And particularly when rates overall have gone up. So a lot of your fixed income assets, even on the long run, have to be marked down. And so it becomes a very murky situation. And it's amazing. It's one of these things. It's amazing how fast these things can unravel. And unfortunately, having been through a couple of these cycles, it brings back a lot. I don't want to over analogize this to the global financial crisis. Let me be very, very clear. We're not looking at that now. But the mindset is when one bank gets into trouble, it's like, well, if you see a roach somewhere, there's probably others. And that's kind of what happens. People get very nervous. And when your money's at risk at a bank, the idea of return on capital takes a huge backseat to return of capital, which is why we saw money flow out of banks in a hurry and into short-term fixed income, causing huge drops in bond yields and in short-term fixed income yields.
Right. And that's what we've been discussing a lot today. And of course, yesterday. Does this feel like the great financial crisis? Is this idiosyncratic to Silicon Valley Bank, or is this more systemic? To your point, I don't think it's a systemic issue like we saw in 2008, 2009. But when this news first started coming out, the narrative was, oh, this is the company that, helps build crypto firms, or crypto firms keep their money with this bank. And it just became a crypto thing. But then when you
well, that was the silver. Let me interrupt. The Silvergate was the crypto thing. And I think people were very easy to say about Silvergate. Yeah, it's crypto. Goodbye. Right. Silicon Valley is a different element because, what companies do you and I normally talk about? Those are the big tech companies that right. Quite frankly, keep the lights on for us right now.
Right. But that was my point. Yeah. That's what I was getting to.
Yeah, sorry.
They do make investments into newer tech firms like this. And that was kind of the first thing that came out. Oh, it has to be associated with crypto. But when you start pulling back the layers and getting into the details, this is really who is helping to build private equity and VC and these companies that do come to market. So that's why it feels, once you started pulling back the layers, it felt like that, the feelings that came back from 08, 09 for that reason. It wasn't just, oh, it's a crypto thing. So that's why I feel like, you're starting to see the similarities and emotions.
Yeah. Oh, absolutely. And the other question that's being asked, that's very specific to SIVB because, ultimately, these people really are, have been financing a big portion of the, let's say the pre-IPO world, which is very important to us because, we're talking about, you and I talk about public companies, but they have to go through a growth cycle before they get to that point. But the other problem you have is, so beyond that, though, the contagion aspect, and I'm not going to call it contagion because that's not necessarily true, but the reassessment is, okay, if this bank has a funding crunch here, if this bank may not have marked all its assets to market properly or reserved against bad loans, who else isn't? And the problem is when people are making that decision in the course of a few hours, rather than taking the time to look at it over their balance sheets, that's when you get into trouble. And that's kind of what we're seeing now is people are reacting without really having had time to do the analysis that's required. I don't think every bank is in trouble. And they're not all trading that way, but the market is picking the ones that seem to be the biggest risks and fleeing those. And that's why that's the situation we've been in for the last day and a half. It's amazing because we weren't even thinking about this at like 1 o'clock yesterday afternoon, Eastern time. And then boom.
The one similarity is, and I'll never forget this, JP Morgan working over the weekend, trying to figure out what they're going to do with some of these banks. There's going to be a lot of work happening this weekend as well, with the government, FDIC, all the banks, and figuring out what this looks like next. So I would say that's probably the biggest similarity is everybody working over this weekend for sure.
I'd be shocked if some larger bank doesn't try to make a play for their assets because you've got some, the relationships that are out there are phenomenal. But again, I don't have that granularity into it, but I'm just looking at this going, that's a business, they had this great business niche. Somebody's going to want that niche. And the question is, what's left for the depositors and the stockholders after that becomes a different question. But I think somebody's going to want the bones of the bank, so to speak.
Of course. Well, if you have underwriting as a big part of your business, you certainly want to take a look at that. Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.